Hello, everyone. Thank you for joining us today. My name is Andrea Armeni. I'm the Executive Director at Transform Finance, and I'm the convener of the Transform Finance Investor Network. I'm honored to welcome you today for this presentation with Joseph Curtin on promoting worker voice through a democratically managed holding company, the Staffing Cooperative. Through this presentation, we will touch on a few themes, as you see already from the title, that are near and dear to our heart as well as to yours, from the issue of worker voice to democratic management to wonky such as the whole code, all in the context of a cooperative. So very glad to be joined by Joseph today. A very quick update on our end, and then we'll turn it over for the conversation itself. We now have underway the research interviews for a project on capital and equitable communities. Some of you might have received an email on that. Essentially, it's an effort to show that, as discussed previously when we presented the Boston Ujima project and the Benvivier Fund a while back, the process through which capital is allocated in communities is itself part of the outcome as we try to create equitable communities and merge the gap that there is between economic power and political power. So if you know of any particularly good examples of community voice, community governance on how capital is allocated, please let us know, and my colleague Emily Sladek might follow up with you for a more in-depth interview. And relevant examples would be anything from democratizing capital East Bay that you might be familiar with, again, Boston Ujima, and other efforts where really it's not just about the capital, but it's about the process itself and the way in which community voice is expressed through actual governance mechanisms. Also, a quick update for those of you that have been following our cohort, The Future of Workers is Now, which tries to support worker justice organizations. They're trying to develop capital strategies or capital side approaches to advance worker justice. We had the second gathering last week. Thanks to all of you. I see a couple on the line that were coaches for that cohort. The feedback has been tremendous. For those on the line that are investors, if you're interested in supporting these organizations as they deploy their strategy, please do get in touch. And support might mean a variety of things. It might be deciding to amend your investment policy statement in accordance to what they put forth as high road practices, or it might be connections to pension funds or to fund managers that might be interested in pursuing worker justice strategies anywhere, as we're seeing, from the venture capital space to muni bonds. So lots of exciting stuff there. Please do let us know if you'd like to learn a little bit more on that. Now on to today's topic. Really, I boil it down as the issue of worker control and how alternative structures can foster that. Even looking beyond the traditional kind of single entity cooperative worker co-op that we have been looking at. There are, of course, a few meaningful links there to some of our prior inquiries. One that Joseph will address directly is this issue of economic consolidation, for example, in the staffing industry. How a few companies are gobbling up an otherwise fragmented space, and in the process are driving wealth extraction. So I think that's the issue of staffing companies is really one of the most salient examples, if you think of it as being an intermediary between really do the work and those that need their services, and just taking a very significant cut of it. But also other themes that are dear to our heart, like centering the voices of excluded populations, in both wealth creation and in self-determination and decision-making. And then as we touch on the structural issues of the holding company model, we'll look at how that the structure can follow purpose and how we can repurpose structures. So the whole code that has been around for a while, can it really be repurposed as a structure that can both create a diversified wealth building opportunity for workers and a de-risk the opportunity among a variety of entities. And that, of course, has to do also with the concerns around the scale and with flexibility in employee ownership models. But with that, I will turn it over to Joseph Curtin from the Staffing Cooperative, who has kindly joined us today. Joseph, thank you so much for being with us and for sharing your fantastic work. I will turn it over to you now, and I look forward to the presentation. We'll hold questions for the end. For those that are joining us through the platform, you can always use the chat function to send a message to me, to Joseph, or to the group at large. We look forward to your questions that Joseph will address at the end of his presentation. Thanks, Joseph. Welcome.
Awesome. Thank you, Andrea. And Kurt and Sophie, also thank you so much for helping kind of like curate this and connect me up with this webinar. Super excited to be here. Lots of familiar faces, so that's great. And also a bunch of faces that I don't know, so that's great too. So we're actually going to start with Genesis, with the start of what we're about. This company started about 4.5 years ago. But before we go into that, I'll give you a bit of background about myself, and then we can talk about the structure at large. So my role is Chief Coordinating Officer at the Staffing Cooperative. Like many other staffing firms, we have a management structure, but what we center is both the workers and the purpose. And I can get a little bit more into that, but a bit about me. My background is actually in computer science. I went to Drexel University in the byproduct of a bit of social privilege. So I was raised in a great house and a great family and benefited from that. Like 1 in 3 Americans, though, I do have a criminal arrest conviction. It does not affect my life the same way as it affects others. But through kind of like a series of circumstance, what I really wanted to kind of like start with was the fact that we as workers actually together make a huge difference in the world, but also we share a lot of similarities that sometimes are just beneath the surface. So with that, I'm going to a little bit of a backstory of genesis of the project at large. So the problem, the staffing industry is old. It's actually turn of the century, industrial revolution came to be because firms were looking for a way to fill temporary roles in factory work, in industry, the birth of the consultancy and management as a service started this trend towards externalizing a workforce instead of bringing on full-time labor. So the value proposition to businesses are pretty straightforward. You have the ability to find talent and the ability to use that talent without actually incurring the most risk as an employer of record. But the problem that we've seen is tenfold. We see workers on one side getting exploited for time that they're billing. On the business side, we see overpaying for services that could be housed in-house or that could be a more transparent way of doing business. And the staffing firm generally sits at the middle of this exploitive relationship. So 4 years ago, I started this work with a group of individuals out of Baltimore. This was a hackathon project. So a hackathon is an adult science fair. You get into a room and you decide to create something to solve a problem. The problem that we started to address was recidivism, was people coming in and going back in to jail. The program itself that started this was actually out of DC. The workers that came to that hackathon were looking for a solution for more than just work. They were looking for access to stable housing. They were looking for access to benefits when they come out of prison, as simple as an ID, right? But the project that we started with was something a little bit different. My background in software engineering, I actually worked for a company called Deploy that did a hiring platform that allowed workers to upload video resumes or interviews and get sent directly to a hiring manager. The data that was coming off of that platform, however, was disgusting, both from a racial justice and from a just blatant best practices standpoint. The management of that firm was completely and utterly devoid of what I would consider heart. So when I went to this hackathon, I thought, let's bring us a technical solution to this pretty human problem. And let's build a platform that we allow returning citizen workers to show their face and tell their story and get hired directly from companies that know what's good and what's up. I was quickly turned around from that decision by the wisdom of the workers themselves, and they said, a list on the internet with names and faces admitting criminal arrest conviction probably isn't the best tactic to take. But what was the foundational point of what we were talking about was jobs, was access to steady income and access to opportunity. So we decided to create Core. And Core came to be out of shared struggle. So Core came to be because we placed somebody within 3 months of actually trying to get the platform up. And the central point was that we saw staffing as an extractive enterprise, and we wanted to change the way that it structurally functioned. We saw that the only solution to avoid what we considered tantamount to slavery was to allow those workers to own the firm itself. So we set out to do that, and we built Core Staffing, and within a year, we grew to about 35 workers, encountering many problems along the way. So both, structural, so just getting to work, just having the ability to have childcare, having stable housing. Besides all these factors, we saw that people felt ownership over the firm, and they felt responsibility for one another. Things like purchasing a vehicle. People pooled money in order to actually get these vehicles to then take each other to work. Things like when they leave the co-op, they would work for an employer that we actually started the relationship with. What we saw from this was that the workers, when they actually felt like they were at the center of the equation, the outcomes were incredibly different. And the one thing that we think is low-hanging fruit, but that seems to be profound in a city with a recidivism rate of about 51%, is after 3 years, still 95% of our formerly incarcerated workers, 100% of our formerly incarcerated workers are still home, are still on the street, are still, with us. And they got to thinking, if this works so well for them, what else could it work for? Who else could come into this network? And they asked me, Joseph, it's been a year. You're still not taking a paycheck. How are you even existing in the world? And I was like, well, product of a little bit of social privilege. I have a bill rate of about $120 an hour, doing software engineering. They're like, oh, damn. Can we bring other people into this like this? Like, are there more people out there like you? And I said, great point. Let's maybe think about that. So they actually decided to open the doors to their business to other workers of different sort of industry experience. Simultaneously, or around the same time at least, my best friend Jeremy and I started a meetup, Be More Black Techies meetup. I'm not good at naming anything, so anything that is that's really cool, I had nothing to do with. So Be More Black Techies is a black tech meetup in Baltimore, right? We were tired of playing Where's Waldo and all of the tech spaces, and we just figured that we would put out a shingle and see who came. So within the first week, we had about 10 people come to the meetup. And in a year, there was 1,000 people on the meetup page and 40 to 50 people attending every week. At the same time, I was drinking the co-op Kool-Aid pretty hard. So we instilled a steering committee in that group, allowing the community to actually come together and decide on programming, decide on leadership, and decide on how the group was run. What came of that was super interesting. First, a lot of these workers had worked for tech companies, but they also had worked for staffing agencies, things like Aerotech, Allegis Group, that have a really strong presence in Baltimore. And what they saw was an opportunity. They saw core as a model that they could actually replicate, that they could see themselves in. And so they came together and decided to create Tribe, a tech staffing solution for companies looking to hire both diverse talent and also talent that owns their own labor. The last piece of the puzzle came together when both of those groups met. What they saw was an industry that is $150 billion and growing. They saw an opportunity to disrupt, in the truest sense of disruption, at a structural level, a relationship of extraction and a relationship of power dynamics. What they saw is that some firms took as much as 65% of their pay, meaning that if you had a bill rate, and I'm using $100 just as a round number, if you had a bill rate of $45, some firms add as much as 0.65 on top of that. What we decided to do was to allow for every worker, because of the structure that we're putting together, to own more of their time. Not only that, what we thought was that there was no voice in these companies. So from a very practical place, not from a place of co-op evangelization, from just a very simple first principle place, we thought workers should have the right to own their time, and workers should have the right to say what they want and have voice in the company. Now this created a problem. How do we actually do that? How do we put this together? So what we decided to do was a couple of things. One is we decided to go after a grant. And through some support from the Workers Lab, we had a bit of an experimentation period. And what we came up with was what we believe is truly extraordinary, in that we brought together workers of, software engineers on one side of the table with people coming out of prison and jail that barely completed high school on the other. And we jammed, and we decided on things, and we understood what happens when workers come together was creativity and new innovative ideas. So this was not something funded by some institution. This was purely from the bottom up. And this is what we came up with. How does it work? So the structure in itself is a holding company. Every firm underneath us, so both Core and Tribe to start, are owned by the holding company itself, starting at 100% with the ability to release some equity at the subsidiary level. Every worker is a W-2 employee of that subsidiary. However, they also are a patron member, employee member of the holding company itself. They get Class A common equity with one member, one vote. This structure is facilitated through our membership criteria. So we wanted to keep the actual membership share affordable but meaningful. So we came up with $250 as a buy-in price. Now, of course, we don't want people to pay to work. So we decided that we were able to deduct 1% of every paycheck to go towards that $250 over the course of 90 days. That 1% membership due becomes a recurring annual membership due. Lastly, we wanted to encourage participation. So we decided that every worker, regardless of what subsidiary they're in, needs to attend at least 3 member meetings in any entity and work for a minimum of 10 hours, either at the company itself, internally placed, or externally placed as a actual contract labor. We decided also that this work could not happen without the support of philanthropy or without the support of a nonprofit fiscal sponsor. So we decided to, and this is completely ripped off from Democracy at Work Institute, but create a think and do tank, right? The ability for workers to come together, ideate, and create new solutions was facilitated by a grant. And the only way that we felt like workers who are consistently disinvested can have the opportunity and actual time to come up with these solutions. So our fiscal sponsorship, our fiscally sponsored program does member development. So things like cooperative education, very basic sort of like job skills training, as well as new product development and new industry development. Lastly, we decided that we wanted to have capital at the table. We didn't want it to be the loudest voice, but we wanted it to be there because we believe that capital, while it is in and of itself inanimate, the people, the actual human beings behind that, bring with them a wealth of knowledge, network, and experience. So we decided to allow that to happen at 2 levels. first, and a Class B preferred equity at the holding company. Out of a 9-member board, 2 of those board seats are for investor members, and they vote pro rata per share. At the subsidiary level, we are open to common stock investors. So both at the holding and at the subsidiary level, we're allowing our network to grow through using capital as a tool for the workers themselves. Lastly, we have a great team behind us. So first, centering workers and people in disadvantaged situations, we think that this is part of our power. We think that people coming out of prison and jail, we think that people in the minority sector, like people that are truly at the center of this work, need to represent our values. So our leadership team is comprised both of workers from, everyday laborers to doctors and to, UX engineers. We think that these constellation of workers provide a leadership team that can reflect the values that we want to put together. So why now? I mentioned before that we received a grant. So the grant actually came from the Workers Lab. It was for $150,000, and that allowed us to get to the point where we are right now. We also have partnered with Seed Commons, which is the Working World's national network, to provide both financing for invoice factoring, which I can get into in a little bit, as well as support on the ground for the workers themselves. Lastly, we were a part of Start.co, a scale-oriented cooperative accelerator based out of Boston that's looking to help, or that has helped us kind of get to where we are right now. And the opportunity that we really see is both structural, but also it's scale-oriented. So what does our competition look like? What is the landscape of staffing today? While big names like Randstad and Robert Half seem to have a monopoly over the industry, it's actually not the case. This is an incredibly fractured market. So with those biggest firms only taking about 6% of the total pie, that leaves mom and pop staffing firms to operate in niche markets across the US. We see this as an acquisition and conversion strategy that we can employ in order to actually turn the tide in both from a worker ownership perspective, but then in the conversation around this industry at large. So how does that work? So first, we look at a company in its most foundational part. Who is the founder? What is the makeup of the company? Does it reflect our values? Second, we do an analysis. Can we actually assume this risk? Can we actually take this company in? And we've partnered with Project Equity based out of the Bay Area to actually help us with that assessment and analysis. The company itself we're targeting will obviously have to be financed through a mix of debt and equity. That being said, we will also provide some capital from the workers to leverage that company into the network. Lastly, we don't want the exiting founder to just pack up and leave. We think, again, that the founder themselves and that the people that have been running these companies should stay a part of the management team in order to make a smooth transition to worker ownership. So we're being very practical about how this actually plays out. What's exciting is that we have our first deal in the pipe, and we're actually looking at targeting other deals in the future. So in order to get this work off the ground, we've, again, raised a bit of money to start, but we're actually opening a seed round of $750,000 for investment. That's both at the holding company as far as a investor member share, and lastly, for that founding investor member share, we're allowing for there to be a basically sweetener of 1% of the equity per 100,000 at the subsidiary level. Now, where is that going to go? Why do we need that? At the Staffing Cooperative at large, the primary reason is that we're looking at new deals to come into the pipeline, providing both legal and accounting support to those transitioning out founders, as well as developing internal capacity. At Tribe, we've developed a platform that will support not only just Tribe, but the entire network and any new company coming in. This platform allows for members to get placed, to do recurring billing, to do invoicing, and also to do time tracking. And lastly, of course, Core. What we think is the center of our model is this foundational principle of worker ownership that came out of CORE itself. So we're looking to raise money to help CORE transition not only from a staffing cooperative itself, but also to providing member support in the form of housing, in the form of job training, things like that. So with that, I'm actually going to bring on Dan Flannery to talk a little bit more about what, in his view, as Balanced Rock Investment Advisors, makes the staffing cooperative so exciting. And what I love about Balanced Rock itself is that it takes a democratic view of financing. It allows everyday investors to actually invest in social change. So with that, Dan?
All right, thanks, Joseph. Can you hear me?
Yep.
Can you hear me, Joseph? Great. Hi, everyone. Appreciate the explanation. Again, Joseph, it's always good to hear about how it all comes together. So I am the founder of Balanced Rock Investment Advisors. We try to help people invest in ways that reflect their values, both in and out of the public markets. When we learned about staffing co-op, CORE, and Tribe, we realized we wanted our investment dollars to go to support not only the growth of Tribe, which we see as a wonderful opportunity, but also the growth of staffing co-op generally, and the growth of more CORE-like opportunities, which is where this, you call it a franchise or conglomerate, whatever the model, and we think that's a wonderful opportunity. I think it makes sense for impact, but also diversification. Tribe sounds great, but it's a new thing. To the extent that Tribe isn't successful, and if that, we didn't want an investment that unduly burdened CORE and staffing co-op, which is why at the top level we have a low return equity or fixed return equity investment. But we also wanted a way to participate as seed investors, angel investors in Tribe if that business did take off. And so we've sort of come up with this, as Joseph mentioned, the idea of a sweetener in Tribe with an investment in staffing co-op. And so, we came to this understanding that, capital was going to be needed in various parts of this group of businesses, and that this provides us a bit of an option, to the extent that there is success. We think that the total returns, to the extent that there is any return from Tribe over time, given the structure, would be quite reasonable from an investor, equity investment perspective. We are also excited by how simple this idea is at its core. Staffing, as Joseph has explained, is not new. There are lots of publicly traded companies out there with tens of billions in collective market value, generating billions in revenue and profit each year, providing really the same service at a higher cost. And I would venture, having worked with Joseph for a while now, it will be a lower quality of service than what Tribe is delivering. And the profits from those companies simply skip all the workers and flow straight to the shareholders. It's not a small market. It seems to me, as I've been looking into staffing, that it really touches almost every facet. I mean, from hospitals to manufacturing to tech, to labor, construction. Everything virtually under the sun has some element of outsourced staffing at this point. And the idea, I think, to return some of the, if not, and I think it's great that we're going all the way to ownership, but even some of the dignity of permanence or of a longer term relationship with your workplace. And if there's sort of a way to provide that in this intermediary by giving people ownership and more maybe benefits, more opportunities, retirement savings, things like that can be put together because it's for the workers and by the workers. Just think the reach of something like this could be absolutely massive, and are really excited to see the different directions that it can go from here. So we're very excited, and we think there's a great opportunity between providing some reasonable capital that won't that's non-extractive and that won't disrupt the business of Tribe and Core and the things that are already going well, but at the same time, and again, from looking at this being a reasonable place to put money that we would otherwise put in public market equities, and hoping that we can derive a similar or better return here is our goal. And so we're excited, and we're just sort of finalizing or working out the final terms at this point of what the subsidiary investment will look like, which I think is sort of leaning towards some sort of a convertible preferred. And one thing about that, we'd like to provide for an alternative exit, something that is maybe based on a revenue-based multiple in the future that gives the investors an option to be repaid for, have their shares redeemed at something that does reflect the potential growth in the company, but that also is a fixed amount that we know in advance won't burden unduly the Tribe, and which it will be able to repay reasonably while maintaining control. And then that would, in our view, be at the investor's option as an alternative exit if there's not a sale or IPO, right? Yeah, that's our view, and we're excited to continue working with Joseph to finalize that. And I do want to say, I try to say this in the beginning, but this is not an investment recommendation. Just sharing some information about our process and the investment that we are working on with Staffing Cooperative and Tribe.
Awesome. Thanks.
Wonderful. Thank you, Dan.
Thank you.
No, I just want to thank you, Dan, for sharing with us a little bit. It's always helpful for the investor network community to hear from a fellow investor, and thanks for your leadership on this deal. The two questions. The first is, since many of us have been quite active on redemptions as an alternative exit model, I was wondering if Joseph is comfortable with it, also can tell us a little bit more about the terms that you're looking at and how you're structuring that redemption.
Yeah, we are working that out. We are looking at potentially a multiple-based number, looking at some comps right now in the marketplace, in the staffing world, to try to, maybe just revenue-based, maybe revenue and cash flow, but something that would use the future, let's say, starting in year 5 or 7, provide an option to investors to be repaid there, which I guess would not be more than 7.5% of the company based on the amount that they're being granted with the initial $750,000 of Tribe, that it would be repaid from cash flows, from available cash flows, probably over a 1 to 3 year period in that if redeemed.
Great. So it would not be structured as a traditional cap, like a 2x on the amount of the investment. We're not leaning in that direction right now. I think we like the idea of a more market-driven, and at the same time, we don't. If 2x, if it's just not big enough to support 2x, we don't need to take 2x either. I think that's how we're looking at it. So because the business, if they're running at a 25% fairly fixed margin, we feel that if the multiple is reasonable, we should be able to be redeemed in a reasonable amount of time from free cash flow, and that would be the goal. And certainly, the more revenue, the more free cash flow, the better. But yeah, we're looking at, I think, a more market-based valuation. Wonderful. And one more thing then. So given, as you mentioned, the potential for this to really grow because of the amount of staffing needs that we see in the industry at the moment, what do you see as some of the obstacles you perceive for more investors to join in? Do you have a sense of what kind of pain points other investors have been seeing?
I'm sorry, is that to me again?
Yeah, so do you have a sense of how investors are looking at it?
Yeah, well, I'm not sure generally. I mean, I think this seems very attractive. I think it seems like a very reasonable investment given the landscape of what I see in terms of impact-oriented and cooperative investments. I think they've done a really interesting thing in creating a for-profit subsidiary that can provide some upside in addition. I mean, at some point when you're trying to construct portfolios that will hopefully generate market rate returns, you can only invest in so many risky 3 or 4% fixed dividend cooperatives and still expect to make any money in the long term. So I think to provide to individual investors and others who are in this space looking to diversify and willing to take some risk, but also looking for an opportunity to make a market rate return or potentially better, I think this should look fairly attractive if you believe in the company and the opportunity they have.
Thank you.
Andrea, I wanted to step in one little quick second and go back to the model, if that's cool, and talk a bit about cash flow, if that's all right. Awesome. The last little nuance that I wanted to make sure that folks got. So why we structured this way also in like one piece of nuance is the investment at the subsidiary level, the actual tribe or core or any new subsidiary itself, does isolate that subsidiary a bit from the network. So if there is risk, it is distributed both in the new opportunity and it's incubated underneath the holding company. So one thing that we're seeing with the acquisition is we are investing right now in figuring out existing or transferring both knowledge and wisdom and kind of like the book of business of existing staffing firms, as well as looking at incubating new projects, right? So when we're actually getting workers together, software engineers, designers, but also folks that are in the construction trade, folks that are in the food trades, we're seeing that like those innovative ideas and people rubbing shoulders, that's actually what the outcome that we hope to see, right? So using staffing as the kind of like beachhead into these industries, that's really where we see innovation happening. And that's really where we want to make sure that when we are investing currently, it's in bringing in expertise in the staffing industry in order to then, obviously grow the network and targeting industries what we think are the most vulnerable populations first. But then second of all, also tying or mixing in with both like high earning, middle and low earning members, right? So we do want to diversify the risk by also diversifying the group of businesses that we bring into the portfolio. So just want to make sure that I point that out, that it is subsidiary growth, right? And that risk is isolated in the subsidiary, but it's obviously all cooperatively managed. The last little nuance as far as the idea or the kind of like overall structure is the management. And I want to make sure that I touch on the management as well. We are not a collective, right? So we do have a management hierarchy. Now the question for the hierarchy happens at the subsidiary level, meaning the way that core is managed is very drastically different than the way that tribe is managed. That said, they both are serving different needs. So where core needs more case management support, tribe does not. So our management team at core is different and comprised of different people than at tribe. That also said, when we're looking at industries and markets where we need expertise and where we need new kind of like leadership, we do have, we do staff leadership into these new subsidiaries. So, for example, my role, I'm at the holding company itself, but I'm on contract basis for running tribe, right? So the idea that the workers at tribe can actually revoke my contract is very real. So that does produce an accountability measure that we have never seen in the staffing industry, where you've never had the ability for contract laborers in a staffing company to tell the management that their contract is getting revoked. So just putting that out there also, that like when we're talking about nuance, both in the terms of diversifying risk, but then also in the terms of management capacity, and also in the terms of allowing the members to actually speak on behalf of their, of their rights. So just want to make sure that I point that out.
Wonderful, thank you. Can I put out a couple of questions, Joseph?
Absolutely, please.
Great, and please, for those that are joining us via the WebEx app, feel free to put your questions in the chat box. One is on the structure from one of the knowledgeable lawyers on the line.
Say that one more time. Sorry, I think you dropped off.
One of the questions from one of the knowledgeable lawyers on the line is, what are the corporate entities for the holding company, tribe, and core? Are they three separate Delaware corps?
Yep, absolutely. So the holding company itself is a limited cooperative association formed in Colorado. So it is a multi-stakeholder cooperative in the Colorado sense of that word. Tribe in and of itself is a Delaware C Corp, and core is an LLC formed in Maryland. So each new subsidiary that comes in, we want to keep it simple. We want to keep the subsidiaries as LLCs or Delaware C Corps as they're kind of like as we see fit. No need to complicate the model. No need to complicate the model for it.
Great, and there was then a corollary question to that in terms of not complicating, which was why do the holding company in the first place and not another structure like a hybrid new generation co-op that would allow for the two groups of stakeholders, for the investors and for the patrons to use the same structure? Is that because you have multiple subsidiaries?
Yeah, so I like to reason from first principles. And the way that we came to this structure was because we had two very different groups of people sitting down at the table together, right? So we look at these structures of the subsidiary holding companies more so like affinity groups than anything else. Two very structural things that I'm going to talk about. One is at the subsidiary level, W-2 contract per state, that workman's compensation actually varies, right? So in Maryland, one of the problems that most cooperatives face is that there's no actual cooperative form in Maryland, even for a foreign corp to incorporate here. So we would actually, at core, be paying about $55,000 a year as a term rate for workman's compensation. So for an owner of a firm, right? So regardless of if we had one entity, so regardless of if you make 25, 35, 45, 50, but it doesn't matter, we are assessed at that owner equity rate, right? The assumption there is baked into a bit of racism, but it's doctors and lawyers that are owners of firms. It's not laborers, right? So that's where that kind of like rate got locked in. The second phase of this is risk, right? So if we're saying that we're starting new entities and we're bringing new entities in, there is a high chance that some of them will fail. And what we don't want to do is burden core, or we don't want to take core and have it fail because of one entity that it didn't necessarily invest in up front, right? So the kind of the diversification underneath allows us to pool risk in different places. And lastly, kind of like housing technology and the ability to sell. So part of this came out of a bit of obstinance on my part. I was having a conversation with a gentleman named Jim Johnson from Baltimore Roundtable for Economic Democracy, and I was saying, well, why couldn't a co-op IPO? Why not? What's stopping it? People minority IPO all the time, right? And Jim was like, Joseph, you have a lot to learn about co-ops. And I was like, all right, so like, what do I need to learn? Read a bunch of books and all the rest of it. And this structure allows for two things, two very interesting things. First is if we do spin up a product or we do spin up a service, that we can actually sell it, meaning both the actual, again, first principle, both the actual commodity that we produce, but also the entity that houses it. So there is an ability to have massive upside in the sale of a company through this model. And that upside would actually be incurred not only at the subsidiary level to a minority group of small like founders, but also to the workers at the holding company at large. Does that make sense? So if we decide to start a new company and we want to sell it, we have the ability here in this model to sell our company without selling or demutualizing the actual staffing company itself. One of the biggest risks in cooperation is demutualization. And this kind of like is a hedge, for lack of a better word.
To be honest, I personally did not fully understand that part. So let's use a concrete example. You have one, let's say, acquired subsidiary that can be spun off. What happens to the workers and who gets those returns?
Absolutely right. So let's take a very concrete example, right? We currently have built a platform at Tribe, right? The platform of Tribe employs and actually allows those workers to do service at different companies. But that platform in itself is IP, right? It is an actual service, but it's a platform in and of itself that we could not only use for our own benefit, but also we could use for the benefit of other staffing firms as a product itself. Now, if we house that product in Tribe, in the actual entity, and we want to sell that as, instead of the service, but as, and we're not going to do this, I'm telling you this as an example, if we want to sell that as an actual product, there's nothing stopping the firm itself from being acquired or by being bought or by going public, probably not, but by being acquired by another firm. Does that make sense? So the reason why we would want to do that is because if there is that service, and if those workers that built that service or built that product want to leave the firm, we as the holding company have invested in that start, and we've invested in that company, and we own the equity in that company together. So if they leave, instead of leaving and then the entire organization falling, they leave, we get the equity piece, meaning the staffing co-op at large gets the equity, the upside for every worker, and then we progress with the kind of like the sale, right? So does that answer your question? I'm trying to give a more concrete example. From a very first principle place, we don't want the ability to demutualize the holding company. We want to kind of put a poison pill in demutualizing the holding company, but we want to have the ability, if workers want to spin off projects, to be able to sell and spin off projects, the same way we acquire new firms.
Got it.
Okay.
That did make sense. Thank you. And I see a question coming in. Thanks, Delilah. On the governance piece, on decisions such as the sale of a subsidiary, who gets to make that decision?
Totally. We actually, so I want to publicly kind of like produce our bylaws. We've worked with Cutting Edge Capital to produce bylaws that are kind of like in the slide deck format, which we really love, making it approachable for every worker. So these decisions are made at both the subsidiary and the holding company level. So new acquisition, right? We actually have a 9-member board, and that 9-member board decides on acquisition or acquisition of company. Now, sale of a company is a bit different. So in the bylaws currently, in order to actually sell one of the firms, we need to have a supermajority of members, so actual worker owners, to decide whether or not we should sell off one of the subsidiaries themselves. So both the workers internally to that subsidiary and the workers at large in the network need to make sure that it's in the best interest of the network at large to actually allow for that to happen. So we look at this as kind of like local and global governance. So local decisions, for example, management, day-to-day shop floor decisions, new market growth and opportunities, product development and sales happen at the subsidiary level. Large strategic visioning and large strategic decisions happen at the holding company level through an elected board. And that elected board is representative of the membership as a whole. So that 7-member board seat, we actually stratify by earning. So we have the highest compensated workers and the lowest compensated workers and kind of like represented across the board. So we have representative voice across the board as well. So tech pros don't run the co-op, basically. So the other side of it is, at the end of the day, what we look at is, is this feasible? And part of what the kind of nonprofit fiscal sponsors relationship to what we're doing is to assess and help kind of like guide the co-op in that feasibility of whether, we should acquire or whether we should sell. And of course, working with partners like Project Equity to help us kind of like get that initial analysis together. But we really want to make sure that we have, that the members have all the information rights that they absolutely can, but also that for the largest strategic goals, they have the most influence and most input. But at the local level, we shouldn't burden core with running tribe, and we shouldn't burden tribe with running core, if that makes sense.
Got it, thanks. And there's a question on who is the fiscal sponsor that you're using?
Sure, yeah. So we actually are partnered with Democracy at Work Institute. So Melissa Hoover over there is an amazing human and has allowed us to be very flexible with what we're doing. We struggled for a while, honestly, to get a fiscal sponsor that understood the model of how of worker ownership, first of all, but then second of all, it's kind of like the governance and control or the rights of the workers in the firm itself. So through Democracy at Work Institute, the program itself provides support, again, for both member development, doing the initial research and analysis, as well as new product development and things that we can house under that nonprofit. Excuse me. So yeah, and again, the analysis, and I just looked at Leonardo's question. So yeah, the analysis piece happens with the nonprofit. It's not the decision-making body at all, right? So the decision-making happens at the holding company. It does not happen at the subsidiaries, or does not happen at the fiscally sponsored nonprofit. Just to be very clear with that, we do have an advisory board on top of the fiscally sponsored program, but that advisory board, again, is advisory. It has no fiduciary responsibility, and it's comprised mainly of outside advisors to help kind of like guide the industry at large, or kind of like industry knowledge at large. Yeah. Got it.
Thank you. One more question on the governance piece. Sorry for harping on that on all sides. You had the two board members at the holdco level for the shareholders, the Class B shareholders. How are those two board seats assigned? I imagine in this case it's not one investor, one vote, right?
Sure. So a couple of things. Again, reasoning from first principles, what we decided was that we wanted capital here. But what we also decided was that within the capital kind of like pool, meaning within the Class B shares, we wanted them to have voice, but also wanted them to be representative of their commitment. So we actually do pro rata voting rights in the Class B pool. That being said, every investor, regardless of where they come from, have visibility within the both holding company and subsidiary structures. Again, we think that the ability for us to have guidance and have kind of like an advisor in our investors is actually really great, right? So that's kind of like the voting rights is pro rata per share holding. And, again, we do have a minimum check size, so we're not kind of like, crowdsourcing this. We are looking at individual investors and PRIs and things like that in order to actually make it manageable at the holding company level. The second piece is in the common stock investors, the subsidiaries. They vote pro rata. They vote per share. It is preferred in that, they get paid back first, but it's not preferred. It votes like common, right? So for us, what we think is, the members of the holding company at large obviously will have the majority say in any decision at the subsidiary level. But we do want there to be some rights for the common stock investors. If we get to a place where one of our subsidiaries we've sold off 49% of it, that's a pretty big percentage that we're willing to stomach, right? And what comes with that is investor membership voting rights. Last thing is, and this is actually really interesting and kind of like outcome, going back to core. So in the beginning, when we decided to form as a co-op, one of the things that we really looked at was what happens when somebody leaves. As a staffing firm, you're an intermediary. That means you're temporary. And we thought a great outcome for our members at CORE was to find W-2 employment with an employer that they really wanted to work for and that cared about them. So we didn't want to disincentivize that. We do a conversion fee. So the staffing services at large, you do pay for contract, but you can also pay for finder's fee, right? So what we decided was we allowed members who are leaving the co-op to become investor members from a portion of that conversion fee. So through no work of their own, they would just magically become investors. No, they have to be members. They have to participate. They have to have say and voice in the company for at least 3 months in order for them to actually be eligible for that investor membership. Secondly, that capital that they provide obviously comes first from that $250 buy-in that they did themselves. So we want people to feel worker ownership, right? But the second piece of it is that investment from the company, meaning the purchase of that W-2. We don't want to sell people. We want to have the ability for those people to come and invest back into the membership, and we think that will produce more outcomes of those companies hiring new people in the future. So just putting that out there also, that what we want to see is employee members or employee patron members converting their equity from patron to investor and back from investor to patron when it makes sense for them. So they don't lose their kind of like place in the co-op, and they have that network of support around them. And this actually was piloted and it started by a member at CORE. So a member at CORE has $250 today in CORE in the staffing co-op, even though he's making $13 an hour working in Baltimore City, right? So just this is coming from that most beneficial to the worker place.
Got it. Thank you. One more question that came up offline today during a conversation with Erin Sahan from a World Fair Trade Organization that looks at really embedding this element of fairness throughout all of the dealings of the enterprise, so in terms of its supply chain practices, lending practices, contracting practices. Besides the worker ownership piece, are there any other kind of mission constraints that are in place?
Yeah, so of course what we're looking at in CORE and projects like CORE is support for the workers. So that nonprofit fiscal sponsored project, while it is meant to help kind of like bring in new subsidiaries and bring in new deals, what it really also does is help us provide for the most basic needs of the members across the board, right? So both from things like housing, access to financial institutions, financial education, those sort of like mission-oriented things happen at the nonprofit layer. That said, also the employee membership Class A investment or their buy-in allows them to have voice. So we think that voice actually will help shape the institution itself, and it already has, right? So from a mission drift sort of a place, we have two kind of like checks on it. One is the nonprofit fiscal sponsored project, and two is the employee voice and representation on the board per their earnings. So it's not, again, one sort of member running the entire operation, if that makes sense.
Yeah, makes sense. Thank you. One more question that came on the line, and then again, I would encourage others to mute themselves if they would like to jump in. If there's potential for competition among the staffing companies, assuming you have multiple staffing subsidiaries, how will the competition be managed?
Right. So a couple of things. One is we are being very strategic about what initiatives we start and not. So we started with CORE, which is labor primarily in food service, construction, and transportation, so driving. The next entity that we started was Tribe, technology, so web development, design, creative, completely different worker base. So first and foremost, we want to be very strategic. The company that's in the pipeline right now actually is an HR and administrative consultancy. So what they do is they place admin positions across the country, both in HR professionals and also just admin, right? Just, like secretarial work. So what we think is we want to provide pathways for members between subsidiaries. So competition actually plays well into our model. So we want there to be the ability for a member to move from core to tribe seamlessly because of their membership at the holding company level. And we think that education, as far as the worker, kind of like, again, where the fiscal sponsored project comes in, that education component helps those members navigate those career pathways throughout the holding company itself. So that's like the grand vision, and we're, one bite at a time. But like the hope would be that you can actually have career ladders within this holding company structure itself. And yes, this is kind of like a temporary situation, but we think that that's actually the way that people kind of, A, that's the way the world is moving right now in kind of like the gig economy. But B, I think that that allows members to actually have multiple opportunities put in front of them.
Very clear. Thank you. Let's see. Last thing on my end is on current open round. Can you tell us a little bit more about the firms, or how people can get in touch, or how to learn more? Any restrictions,
sure.
geographic or otherwise?
Yeah, so we are relying on state exemptions, and we definitely are open for the round. We hope to close it by the end of the year, and we're about halfway there as far as like total committed, or total kind of like, maybe not committed, but total commitment actually. So what we're trying to do is this, is at the holding company level, we have a target dividend of 8%. Really simple to understand. It is a 5-year commitment, and it's an 8% target dividend. But with that, there's a 4% cumulative floor. So the basic, the most, the least that an investor would make on their investment would be 4%, and they'd be paid back obviously before the workers get paid. Lastly, at the subsidiary level, that 1% per $100,000, we're working through terms right now about comps and kind of like the revenue multiple that we would agree to. Again, it's industry-based, so this is revenue generated at the subsidiary level at any subsidiary per that 1%. So the last nuance of this is any new subsidiary acquisition that comes into the market, or into the firm, we are allowing for investors to have equity, to participate in those deals. So both at the holding company, Class B preferred equity with a target dividend of 8%, 4% floor. At the subsidiary level, 1% as a sweetener to the deal for any equity, any per $100,000. And then new subsidiary acquisition, the ability to participate in those new subsidiary acquisitions. So what we think is it diversifies risk at the top and also allows for upside at the bottom. So that's one. How you can get involved, it is a membership, so it is a membership subscription. You can contact me directly, Joseph at staffing.coop. I'll provide the slides also with, obviously, Andre, you can send them out, and it has my contact information. We are not geographically bound, so we do have a minimum check size of $20,000. We're looking for both philanthropic support in the nonprofit, and we are also looking for investor support at the holding company and subsidiary. So we do have the fiscal sponsored project, if that is more aligned with your kind of like investment thesis. Lastly, we are looking at potentially in the future, this is not today, we are looking at providing some sort of donor advised fund or partnering with the donor advised fund for the acquisition financing itself. So allowing for that kind of like the ability to keep money circulating within the network to reproduce this acquisition strategy. That's future. We have not put that up, but I just want to put that out there as something that we're thinking about. But currently today, the offer is for both the holding company at large and the current 2 subsidiaries, so the core and tribe. And the support would go primarily to new acquisitions, to supporting tribe and getting into the market, and obviously the most basic administrative and the most basic worker support at core to support the 35 workers we currently are placing.
Wonderful. And last thing to clarify on that, there is no debt layer, correct?
So there actually is. So we've partnered with, so 2 things. At the holding company, we've actually partnered with Seed Commons. And Seed Commons is the network of co-op loan funds anchored by the working world. So we are part of that network. They have actually provided us with seed capital of $150,000 to do payroll factoring for any worker. So the primary, problem with most staffing industries staffing businesses trying to get off the ground is that they need to pay the workers before they actually receive the money from the companies. And we've, through that investment vehicle, we've allowed them to participate both in a 4% sort of like target, a 4% rate for their just strict debt, like revolving loan, and also have a sweetener of 4% for investment into the holding company itself. So if they would, if you do want to participate in the debt side of things, that would probably be the best avenue to do that, is to actually do, add to that pool at Seed Commons. But we currently are not actually looking to bring on debt at the holding company layer currently. When we do an acquisition, of course, there's room for debt to play, but not at the holding company. So not for this current offer, if that makes sense.
Great, thank you. And Delilah followed up on that, saying that, it would be helpful to see a visual of the capital stack or the blended capital structure, both for the holdco and for the subsidiaries. I don't believe you have that in the slide deck, but if you might be able to.
Yeah, I don't think I have that in the slide deck, but I can definitely follow up with that. So yeah, I'll just follow up with that with you, Andrea, and you can share that with everybody. But yeah, primarily in the holding company, it is equity, and the other side of it is at the subsidiary level, it's a mix, right? So if a new subsidiary comes in, it will be debt and equity finance, and most likely seller financing is the route that we'll go with that. To actually allow the exiting founder to pay for retirement through a seller financing debt instrument.
So the seller would get a partial exit and then reinvest.
Yeah, absolutely right. Absolutely right. So that's right. So that's part of the process, and that's kind of like where project equity plays into it. They've done these deals before, and we're relying on them a little bit for that analysis and allowing us to kind of like make informed decisions about new target acquisitions. But yeah, so primarily founders exiting, and the profile of kind of like the company that we're currently talking to, and the profile of the company that we want to be bringing in. It does have an exiting founder, and potentially allowing for that exiting founder to stay on for 3 to 5 years, but then retire, right? And then leave the business to a successor that we install at the holding company.
Got it. And there was one clarification in the chat about the votes at the holdco level being in conflict with those of the subsidiary in the case, say, of the sale of a subsidiary. Can you walk us through that piece again in terms of how the votes of at the holdco level could be the majority versus those of the subsidiary with misaligned interests?
For sure. So at the holding company level, we will never sell more than 49% of any subsidiary. So we will always maintain majority control of any subsidiary that we bring into the network. The reason that we want this is because when there is conflict like this, we want the majority of members, meaning the workers, not the equity holders at the subsidiary level, to have dominance in that vote. So the holding company itself actually dictates what happens to the subsidiary, not the subsidiary equity holders, if that makes sense. From a very early place, we want workers to have the control, right? And so that happens at the subsidiary, that happens at the holding company and the subsidiary. While we are allowing for equity to play, we imagine and we want it to always be reflective of the workers' desires.
Excellent, thank you. So unless there are other questions on the line, I really appreciate your having been so thorough with your presentation and with addressing our questions. Thank you so much, Joseph. For those of you interested in getting in touch with Joseph, his address is here, joseph@staffing.coop. We'll be sharing the deck as well as the recording afterwards with all those that have signed up. And if you would like to learn more about the activities of the Transform Finance Investor Network or to join us, please contact my colleague Kurt. Many of you are already familiar with him at kurt@transformfinance.org. Joseph, thank you so much for all the excellent work that you do, and thank you for the great presentation today. Very, very useful to learn about the model. I think it has broad applicability. You're really pioneering something super interesting here, and I'm glad to see that we're already seeing some of the very direct impact on the workers, and in particular on previously marginalized populations. So thank you very much for being with us today.
Thank you.
And thank you everyone for joining us. Take care.